Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous?
Midweek check-in. Welcome to Modern Investing Techniques, episode 86, for June 24th, 2026. I'm Patrick, coming to you from Vancouver. Midweek, let's reassess this week's positions and look for fresh setups. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. Tech rebound signals after the $1.3 trillion AI-driven rout could create entry points for disciplined Canadian TFSA investors rotating into oversold semiconductor names. The S&P 500 closed at 7,365, down 1.4%. The NASDAQ Composite closed at 25,587, down 2.2%. The TSX Composite closed at 34,927, down just 0.2%. Sentiment remains under pressure from AI valuation concerns and mixed signals out of the Bank of Japan, where some members are pushing for faster rate hikes. Governor Ueda flagged upside inflation risks that keep pressure on yen intervention planning. The Fed's next decision continues to anchor expectations for U.S. tech exposure, while earnings season highlights divergence between AI leaders and the broader market. Defense spending themes are gaining traction globally, but remain secondary to the tech rotation underway this week. About 16 days ago, we simulated a position in LLY on next-generation obesity drug data, and it closed up 0.17%, showing that even strong catalysts need volume follow-through to hold. Now let's move into today's strategy spotlight on dividend growth over yield chasing. Dividend growth investing targets companies that raise payouts consistently rather than chasing headline yields that can prove unsustainable. In today's choppy market with tech volatility and diesel prices falling below $5 per gallon, this approach offers Canadian investors a way to compound returns inside registered accounts. Start by screening TSX Dividend Aristocrats on Wealthsimple or Questrade using two clear filters: 5-year dividend growth above 5% and payout ratios below 60%. This method has historically delivered stronger total returns in sideways or mildly declining markets through reinvested cash flows. The main risks include sector concentration in financials and utilities, plus the drag from rising rates on high payout names. Canadian investors receive an added benefit from the dividend tax credit in non-registered accounts, which lowers the effective tax rate on eligible dividends. If you want to test this in your own TFSA, pull up the Aristocrat list, apply those two metrics, and compare the resulting names against your current income holdings for both growth trajectory and tax treatment. That brings us to the practice investment of the day. This is a simulated trade for educational purposes only. No real money is involved. This is not financial advice. We are holding fire today with no new position opened. The catalyst for a tech rebound after the $1.3 trillion market cap wipeout is clear, but we still lack the second and third confirming factors. Specifically, we are waiting for a closing price above the prior day's high, accompanied by volume exceeding the 20-day average. Early bounce attempts have appeared but remain unconfirmed on both counts. Zero capital at risk right now preserves dry powder for setups that meet the full criteria later in the week. Our earlier rule about volume confirmation is exactly why we are staying on the sidelines. This midweek update reinforces that skipping trades when signals are incomplete protects both capital and discipline for higher conviction opportunities. Now let's review yesterday's trade. We simulated buying ION on the leadership change catalyst. Market data was unavailable for evaluation, so we could not calculate any excess return relative to the broader market. Without closing prices, we cannot determine whether the trade produced alpha. The new rule we extracted is straightforward. Require closing price confirmation before declaring any catalyst trade complete. That lesson directly influences how we are approaching today's lack of confirmed signals. Let's look at 2 tools and techniques items worth watching. Nokia and Databricks completed a test of an AI-driven autonomous network data platform. Telecom investors can screen related TSX or NASDAQ names on TradingView for volume spikes tied to similar partnership announcements. This development is most relevant for those already allocating to the tech sector. Natera received Japan regulatory approval for its cancer test. The approval expands the addressable market for precision diagnostics and offers a concrete catalyst for healthcare or biotech exposure. Investors can track comparable milestones through company releases or PMDA databases to time entries ahead of commercialization. 3 quick hits round out the day. KNDS plans an IPO in Paris and Frankfurt with existing shareholders set to sell up to 20% of share capital. The European tank maker is beginning the listing process amid accelerating defense spending momentum globally. Existing shareholders will offer shares representing as much as 1/5 of the company's equity in the dual listing. Investors can add KNDS-related European defense ETFs to a watch list to monitor post-IPO liquidity and trading volumes once the shares begin changing hands. The move aligns with broader trends of increased military budgets across NATO members and allied nations. Defense contractors have seen sustained institutional interest as geopolitical tensions remain elevated. No specific valuation range or timing details beyond the Paris and Frankfurt venues have been released yet. Adani launched a 10-gigawatt nuclear power initiative aimed at India's energy security. The project targets long-term domestic power needs and could lift demand for uranium and nuclear supply chain companies over multiple years. Adani's entry into nuclear generation adds a major corporate player to India's energy transition plans, beyond traditional state utilities. Investors holding uranium ETFs should review any India-specific exposure limits or country allocation caps before considering incremental positions. The initiative sits within a multi-year horizon rather than producing immediate quarterly revenue impacts. Supply chain names in fuel fabrication, reactor components, and waste management could see indirect benefits if construction milestones are met. No exact timeline for first power generation or total capital expenditure figures were disclosed in the announcement. Morgan Stanley raised its China humanoid robot shipment forecast. The upward revision reflects accelerating commercialization in real-world scenarios and points to faster adoption curves for robotic suppliers. Humanoid units are now expected to reach broader industrial and service applications inside China on a compressed schedule. Investors can screen automation or robotics ETFs for any China weighting adjustments ahead of the next quarterly rebalance. The forecast change highlights how policy support and manufacturing scale are combining to shorten the path from prototype to deployment. Component makers in actuators, sensors, and AI edge processors stand to benefit if shipment targets are achieved. No revised numerical shipment totals were provided beyond the directional increase. Portfolio performance shows 38 total simulated trades with a 53% win rate. Cumulative P&L stands at $396.68. Cumulative alpha versus the NASDAQ across 27 benchmark trades is plus 21.2%. Average return per trade is 1.04%. Now here's something that most retail investors get wrong, and it cost me money before I figured it out. Imagine you bought a Canadian bank ETF last month expecting steady income only to realize the price already baked in the next quarter's hike. The key distinction is between current yield and dividend growth rate. A 4% yield on a stock with flat payouts delivers less long-term compounding than a 2% yield growing 8% annually because reinvested dividends accelerate position size over 5 to 10 years. The dividend tax credit in a non-registered account can reduce the effective tax rate on eligible Canadian dividends to roughly 15 to 20% for middle-income investors versus 30% or more on interest income. The pro tip most people miss is checking the payout ratio against free cash flow rather than just earnings. Sustainable policies usually sit below 70% of FCF, giving a buffer during downturns. REITs add another layer as income vehicles but carry interest rate sensitivity that requires separate allocation limits in a TFSA. The biggest mistake with dividend strategies is chasing yield traps that cut payouts during recessions. Always filter first for consistent growth histories and FCF coverage before comparing yields across account types. Before we wrap, tomorrow we will examine any volume-confirmed semiconductor rebounds that meet our full criteria. That wraps up today's modern investing techniques. Remember, every trade is a learning opportunity, win or lose. Subscribe, share with a friend who wants to invest smarter, and we'll see you tomorrow. And if you'd rather watch than listen, find us on YouTube at NARA Network. Links in the show notes. And before you go, this show is part of the NARA Network, a family of daily podcasts covering tech, science, markets, and more. If you enjoyed today's episode, give Unintended Consequences a listen. True stories of good intentions that backfired. You can explore the whole lineup at naranetwork.com. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.
Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous? Do you ever stay awake, counting sheep like all the time? What's your life like? What's your purpose? When's your birthday? What's your sign? Are you down right now? Are you stuck up in the past? Are you still thinking about